You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Comperl. The banking sector has weathered rapid changes in the economy and monetary policy the last few years, largely surviving pressures on net interest margins and the balance sheet issues that come from rapid interest rate hikes. Banks are hoping that additional Fed easing and a less restrictive regulatory environment will be sources of relief in 2025 onward. On today's episode, we talk with Jeff Davis, Managing Director of Mercer Capital's Financial Institutions Group, about how the banking sector has fared through aggressive Fed policy, the regulatory changes he expects for banks with the new presidential administration, and how banks can best position themselves given the evolving landscape. Stay tuned. Coming up soon, our interview with Jeff Davis, but first, a quick market update. The November CPI showed a fourth consecutive month of stubborn core inflation, not alarming enough to necessarily stop the Fed from cutting 25 basis points next week, but the stall in improvement will certainly give fuel to those on the FOMC who have been arguing for a higher neutral rate than previously expected. One positive from the report was the 0.2% increase in owner's equivalent rent, driving a 4.7% year-on-year increase in the shelter index, the slowest annual gain since February 2022. Payrolls grew essentially as expected last month at 227,000, with the unemployment rate increasing to 4.2% after October's weather and strike-impacted data. The labor market has cooled, but not to the point of encouraging any urgent action from the Fed. FOMC hawks like Governor Michelle Bowman and Dallas Fed President Lori Logan are still placing more emphasis on the upside risk to inflation rather than the possibility of worrisome labor market deterioration. French Prime Minister Michel Barnier lost a vote of no confidence last week, throwing the French government into disarray with no clear option of a coalition that would form a majority in the National Assembly. President Emmanuel Macron has promised to stay in office until his term ends, but the National Front's Marine Le Pen has increasing leverage to extract concessions out of Macron in upcoming budget discussions. In a span of about 6 hours last week, South Korea's president declared martial law, the country's National Assembly voted unanimously to override the declaration, and impeachment proceedings against the president began. The U.S. bond market displayed no significant reaction to the developments in both France and South Korea, suggesting investors view the political drama as domestic affairs that for now have not spilled into global concerns. The Treasury market mostly maintained the late November rally over the last 2 weeks. 10-year yields have centered around 4.25% through December's big data report so far, and geopolitical developments. Next week's Fed meeting could set new anchors for the long end of the curve if the dot plot or Chair Powell significantly alter expectations for the longer-term path of rates. That's all for the market update this time. Now our discussion with Jeff Davis. Our guest today is Jeff Davis, Managing Director of Mercer Capital's Financial Institutions Group. Jeff, thanks for coming on the podcast.
Delighted to join you, Will.
Our topic today is the banking sector, how banks are faring now that the Fed has begun policy easing, and what their future could look like with changes in federal policy starting next year. The last 2 years have given some pretty unfavorable conditions for banks. The yield curve was inverted for over 2 years. Bank balance sheets were put under tremendous strain, I'd say, when the Fed started to aggressively hike rates in March of 2022. And commercial real estate, which a lot of banks had exposure to, went through a roller coaster of lower property valuations and higher rates. Jeff, from a 10,000-foot view, just very bluntly, this feels like a recipe for disaster in the banking sector. Why do you think we haven't seen more banks fail?
Well, one is usually things aren't quite as bad as as the world will say they may be, and then the flip side is, and maybe we're in that today post-election, is it's never quite as good as the world may say it is. Will, if you had asked me what would happen to the banking sector generally, and maybe the economy, or the banking sector specifically, and the economy generally first quarter of 2022 and you said the Fed's going to raise their policy rates 550 basis points, and not much would happen beyond three large failures that were contained as it related to collateral damage. I would have told you the chances of that happening are slim and none. So from a 10,000 foot perspective, the industry has managed through what is the most, or has been the most difficult rate environment since 1994. And this one was probably worse than 1994, but that was a dramatic one. And Will, it's a combination of things. I think one is the industry went into the rate hiking environment with asset quality that was in good shape. The economy had a lot of tailwind from pandemic era transfer payments and government spending. And the Fed, when SVB failed with the action they took with the term bank funding program, what TBFP, I always have trouble with that acronym, is they contained the what could have been a really significant contagion as it related to the failure of the banks and those three banks, SVB, in terms of what could have been a real liquidity crisis for the industry. It was bad enough, but it was contained, and we seem to be on the other side of it today.
So to your point, I think the overall economy has also proved to be a lot more resilient than people expected when you talk about the aggressive Fed hikes and the high inflation and all of that. And maybe now that the Fed is easing, there is this sense that people can finally exhale and better days are ahead. Do you think that is the case with the banking sector? I know the yield curve just barely normalized over the last 3 months. Does this mean that banks have survived the last few years of those difficulties and they're in the clear now? Or do you still think there are pressures in net interest margins and a lot of banks are still hesitant to add any duration to their balance sheets?
There's a lot to unpack there. Well, let's step back and think about banks and stocks generally. Stocks are going to follow earnings, and the market is always going to be focused on not trailing earnings, but forward earnings, not 3-4 years out, but let's just talk about a rolling year to come. And as the Fed was hiking rates, initially, net interest margins expanded for two reasons. One, floating rate loans that repriced immediately, new loans coming in at higher rates, and banks were able to sit on their deposit rates. And let's also not forget an important equation in the net interest margins is non-interest bearing deposit funding. So traditional banks, even if they had to bid up deposits some, is they still have a block of non-interest bearing deposits on which the spread is going to widen dramatically with whatever those deposits are assigned as part of funding particular assets. So initially margins expanded, Will, but as the Fed sort of leaned into the rate hikes, the NIMs began to contract. And as it relates to these stocks, earnings estimates from, let's say, the beginning of 2023 until really the most recent quarter, analyst estimates for the coming year were continually too high. So as we go through a quarter, the consensus estimates would come down. And that's an absolute recipe for the stocks not to work. And that would be true for any industry. As it relates to maybe thinking about fixed income portfolios, the corollary would be unrealized losses in bond portfolios and unrealized losses in loan portfolios that are not marked to market. And so some investors will focus on the unrealized losses, but I would argue maybe the broader investor would be focused on estimates that were subpar. Street never could get in front of it. And so estimates came down. The stocks were pretty lousy places until one is you could buy after SVB failed, and that would be a great entry point. But really, October of a year ago, as expectations of the Fed was about done, and the 10-year at the time hit what, close to 5% or maybe 5%. The stocks bottomed, but they've really worked since June in anticipation of the Fed beginning to cut rates and to give the industry some relief on cost of funds. I think the net interest margin question, or net interest margins going to expand from here with Fed rate cuts, I think it's going to be a little bit more nuanced. Banks are going to be able to back off deposit rates some, but there is still a block of assets that will reprice down with SOFR, and we'll see how the rate environment develops. But I think it's going to be a little bit more nuanced. And I believe the last piece of your question relates to unrealized losses, or you were pointing to unrealized losses. They're not as large as they were in October a year ago. However, since the Fed cut in mid-September, the 10-year is up, 60, 70 basis points. That is in unrealized losses on bond portfolios and fixed rate loan portfolios is still in the loss position and a TBD as it relates to next year.
In the context of all the distress that the banking sector has experienced that we've talked about, I want to ask specifically about regional banks, because not only were the failures of SVB in March of 2023 really a big focus, but also regional banks seem to have more exposure to commercial real estate. And in a couple previous episodes where we talked about regional banks, the guest brought up the potential for, or maybe it was even me, the potential for a barbell industry where you do have a place for mom and pop banks and credit unions on one side, and then on the other side of the industry you have the massive financial institutions. And so maybe there is something about the regulatory environment or just the way that the global banking industry has developed that regional banks aren't as strong as they were before the pandemic. I think the benchmark index for regional bank stocks has actually improved since the spring of 2023. But where do you see regional banks? How do you see them performing right now?
Let's just look at the stocks, and they've been great the last 5 months. So if you don't mind, Will, let me pivot just a little bit on your question. But for investors, it's a big issue as it relates to, so what's changed? And we've had two things, two big picture events. One is the change in the rate environment with the Fed, at least as it relates to the short end of the curve, with the Fed now cutting. And the second is the election and the coming second Trump administration. Let's compare today and this election to 2016. If we went back to 2016, when Trump won, I think the chances, the prevailing consensus a week before the election was that it was unlikely that Trump would win, and that it would likely be Secretary Clinton. Trump won. It was a surprise. The day after the election, banks took off. And so the KBW regional index between November 2nd, which was the day of the election, and November 23, so 3 weeks later, was up 25%. The index would go on to a little bit additional gains into 2017, the first quarter, but the market's always looking forward. So the anticipation was that with the change in administrations, that there would be less regulatory burden, more M&A. And going back to 2016, Will, the Fed had raised rates for the first time. I believe Yellen was chaired the Fed in December 2015. The economy was a little soft in 2016, so they backed off. And then beginning in December 2016, they began to raise rates slowly. And that was positive for net interest margins. And after whatever it was, 7 or 8 years of zero rates. But bank stocks were viewed as a huge beneficiary under the Trump administration at the time. And the stocks essentially reflected all of that within 100 days. If we fast forward to this year, yes, you're right. Regional banks have been doing great. We had if we looked at a chart, we'd say, well, we had a bottom after SVB, stocks went up, they bottomed again in October 23 on rate concerns, the 10-year, for instance, hitting around 5% or thereabouts, and then came up in the fourth quarter of 23, early this year on, okay, the Fed has now given us the verbal pivot in December of 23. Stocks didn't do much. They actually pulled in some. Since June of this year, the KBW Regional Bank Index is up, let's call it 40%, and that's through as of Friday. So that's a huge run. That's not a run and that would say the stocks or the sector is, quote, in trouble. It would say the future is looking up. And if we date that from the day of the election, the 5th, the index is up 14%. And so I think we've got two dynamics going. And one is back to the summer. So the Fed's done. We're going to get some cost of funds relief. Not coincidentally, with the release of third quarter earnings, the analysts were not chopping estimates like they had been over the prior 6 quarters, where they were continually overestimating the coming quarter earnings. It was just what I would call mostly just sort of truing up. And then the second would be presumably the Trump administration, the second Trump administration, will be positive for the banks. That is, of course, TBD. But in any event, the stocks have had a huge run. But unlike 2016, part of the run began to occur a couple months before the election. It's kind of ironic that Trump has been viewed as being positive for the banks, because if we went back to the 00s or the 90s or the 80s, I think Trump probably stuck it to a lot of banks as a borrower. There's a little irony there, but it is what it is.
I want to talk about M&A. There's this broad expectation that the second Trump administration is going to be giving a wave of deregulation, but there's also a wing of the emerging Republican coalition that is quite populist. I think J.D. Vance has even said some supportive things about the current FTC Commissioner, Lina Khan. Is it possible that the second Trump administration will be similarly aggressive in terms of antitrust enforcement, or how do you view the M&A landscape in the next 4 years?
One, from a regulatory perspective, under the Trump administration, I expect the M&A process to be easier for banks to get deals done. One of the hallmarks under the Biden administration has been the length of time it takes for a deal to get approved, particularly for larger deals. And I expect, as with the new administration and new heads of the FDIC and OCC once in place, as it relates to approving bank mergers at the subsidiary bank level, that process is going to be, I don't know if one can use the term much as it relates to a regulatory body. I believe it'll be much more agreeable to pushing merger applications through the system, unless there's something that is just an outlier as it relates to two banks that are looking to combine will. As it relates to the Fed, in terms of the Fed approval of two bank holding companies to merge, is the Fed is insulated politically, at least to some extent. So in terms of the Fed speeding up regulatory approval, absent significant change at the Board of Governors and the like, which isn't going to happen, or at least I don't believe it's scheduled to happen, is it will be more about tenor of the political climate in Washington. But nonetheless, I suspect the Fed's going to be a little bit more agreeable in terms of its timeline of approving mergers. The other overlay as it relates to antitrust is the DOJ that had with our revised merger guidelines that the Biden administration had put forth here in the last year or two. I would suspect those guidelines at the DOJ, as it relates to broader M&A beyond the banks, will certainly be under review. Let me also comment just on M&A, take that as a segue to M&A more generally. Will, the last 2 years, M&A has slowed dramatically in the industry. in a typical year, 3 to upwards of 5% of the banks and thrifts that exist at the beginning of the year are acquired each year. That'll ebb and flow a little bit depending upon how the economy is performing and that sort of thing. In 2022, and then particularly in 2023, M&A activity slowed dramatically. And it's first and foremost about the rapid rise in rates. So two things have happened. One, buyers' stock prices have declined, and as their valuations declined, the purchase power, if you will, of a acquirer's stock has gone down. So that in of itself is going to slow M&A. And then why did the stocks go down, as we talked about previously, is rates went up a lot. And so we have earning assets on the balance sheets that are underwater. If we want to think about the balance sheet as it relates to the income statement, the low coupon assets are just not producing enough interest income. As it relates to M&A, that becomes a problem because the seller's balance sheet has to be marked to market. So losses have to, whether they're going to be realized or not, from an accounting standpoint, there is a reset to the current fair value, and those marks have just simply been draconian, with rates coming in at least prior to mid-September when the Fed raised for the first, or cut for the first time in this cutting cycle. We'll see how far it goes. Is the fair value marks are not as draconian as they were a year ago for a buyer to stomach, so to speak. So between stock prices up and not as draconian fair value marks, so there's still an issue. We should see a pickup in M&A activity. Deal pricing last year, was at a multi-decade low. Average price of tangible book multiple was about 1.2 times. That to be contrasted with 2018, in the second year of the Trump administration, and where bank stock prices were up, average multiple was about 1.75 times.
Something you brought up on the earlier side of that response was this really important point, which is that just because of the change in administration, a lot of those regulators and the people on the board of governors at the Fed are not going to change with a new administration. So what do you think happens with the future of something like the Basel III endgame requirements? Some of the Fed officials that were a part of that process are still going to be on the board, but what do you see for that going forward?
At the bank level, as it relates to the FDIC and the OCC, it will get a hard look. But the Fed being relatively independent, or maybe fully independent, with Michael Barr still in charge of Basel III endgame, it may be somewhat muddled, if you will. But if he steps down, there have been some questions on whether or not the incoming administration might challenge whether or not they could replace Barr. But if he steps down and say Michelle Bowman replaces Barr, I think she would be more agreeable. We very well may see the Basel III endgame quashed and the issue put to bed. But in any event, the Fed made some changes, Will, back in September as it relates to their how they might implement this, that would not be as draconian for banks, where the additional capital was going to be much more manageable. Of course, the industry would like to see the whole issue quashed, and that may well happen.
Outside of capital requirements and this expectation that the Basel III endgame, that part of it does not come to fruition, do you have any specific regulatory changes that you expect next year for banks? Will there just be a broad tone of less pressure and the screws aren't as tight and banks can breathe a little easier?
Yeah, very much on the latter. That is, the tenor will be much more favorable, the screws less tight, in your phrase. But I do think there's some specifics that where we could look to where existing rules may be rescinded or certainly revisited. So at the FDIC level, we could look at for a review of the revised broker deposit rules that Chairman Gruenberg has put forth here in the last 3 or 4 months. I think a return to what the existing rules were prior to Gruenberg's new proposal would be very favorably viewed by the industry, particularly as it relates to liquidity management and the like. At the CFPB, on day one, CFPB will have a new director. Is perhaps the $8 cap on credit card late fee charges will be rescinded, although that would go against a Trump administration as a populist administration. Also, perhaps as it relates to 1071 and small business lending data capture and reporting, that could certainly be, if not rescinded, it could certainly perhaps be modified that would make it a little bit more easier to implement. 1033 for open banking as it relates to consumer data and sharing with certain parties, that may well be revisited. So there are a number of specific areas, Will, where the regulators have room to rewrite regs or reinterpret them. There are other areas that would be much tougher to do on statutory that would require legislative change. A big one out there is what happens with deposit insurance and whether or not we get an increase in the 250,000 insured deposit cap. If that is raised, my view is it needs to be raised, and whether or not we would have unlimited insurance on business operating accounts. Those are some bigger issues, but in any event, the setup for the industry is much more favorable than what it has been the last 4 years with the backdrop. It's hardly like regulations are going to be hacked away.
Commercial real estate worries were a big story for a lot of the last 2 years, but they seem to have faded for now, rightly or wrongly. Do you have your eye on any potential risks in the banking sector that you feel people aren't paying enough attention to right now?
Yeah, that's a good question. The I the commercial real estate story is largely a story of the office market, and then drilling down, it's the office market in large cities in the central business district. Most of that exposure, not all of it, but most of that exposure is in the CMBS market and is not sitting, at least in large chunks, on bank balance sheets. So let's set that one aside. Multifamily has been an area that we've had some concern, but the sort of negative surprise, if that's what you're asking, would be if rates head back up next year or 2025, because there's clearly a lot of pressure on borrowers, on commercial real estate borrowers generally who took out fixed rate loans, let's say in 2021, even the first half of 2022, who may be coming up on a 5-year repricing. And someone's going to have to show up at a refinancing with a check to put more equity in deals. And the industry has so far managed through that with borrowers, maybe with a little bit of forbearance and a little bit of grace. Let's say the 10-year, for whatever reason, wants to work its way comfortably north of 5. We'll see some renewed pressure in commercial real estate and maybe some other areas of bank balance sheets.
I think that brings up an interesting scenario because, of course, a lot of the economy, a lot of financial institutions were caught flat footed by how quickly the Fed raised rates. But I would say at this point in the economic cycle, people have really shifted towards the idea that, the direction of travel is clear, as Powell said, and that rates will come down. But we have seen that rise in long-term yields especially. And who knows, potentially new federal policies next year could be reflationary to the point of the Fed not cutting rates as much as is priced into market, or maybe even increasing them. But so in that backdrop, What are your thoughts on potential balance sheet restructurings or loss trades that would be a good idea at this point in the Fed's policy cycle and the current state of the economy? Because we are 75 basis points away from the Fed's terminal rate, or at least what was that extended pause, and the Fed is at the same time trying to maintain this very delicate soft landing. So what do you see as good strategies there?
Yeah, well, look, if there's a loss in a security, it's going to be all else equal without the rate environment evolving materially. The loss is going to be realized either in a restructuring trade or slowly through interest income that's below a market rate. I would assume a substantial pickup in restructuring in the fourth quarter this year. For a lot of banks, the earnings this year they've been okay, but not stellar. And so we may see clearing of the decks to set up for a much better earnings on a go forward beginning in 2025. It's easy for me since I don't have the responsibility, but the challenge when managing a balance sheet is and expecting an event such as, quote, the Fed cuts rates, and implicitly, if I'm not going to restructure today, I mean, one assumption may be the long end comes down and I can get out of lost positions at a lower cost. And there's a market saw is that the market and it's kind of cynical, but the market tends to move in the direction that causes the most pain for the most investors. And just looking at the window from September 18th or whenever the Fed first hiked through last week when the 10-year was pushing 450. The irony is the Fed cut one we're waiting for let's see if we're working off the 10-year, for the 10-year to go from 370 to 310. We've gone the other way. So I think part on the restructuring would be based or predicated upon one's view of what happens to the economy next year. And if it's going to run hotter, all else equal, the losses are going to persist until either the bonds mature or the losses are taken, the balance sheet's repositioned to produce more earnings on a go-forward basis. And just as an aside, is my take from, I was once an equity analyst for a number of years, including with FHN, is institutional investors have already accepted the losses, so to speak. So they're really focused on the forward earnings and not the look back. And I can't put words into every institutional investor's mouth, so to speak, but they're going to be more inclined to not penalizing a company that takes a loss in a current quarter to produce better earnings on a go-forward basis.
Jeff Davis, thanks for coming on the podcast.
All right. Thank you, Will.
That was Jeff Davis, Managing Director with Mercer Capital's Financial Institutions Group. I think Jeff's points about the expected changes in banking sector regulations next year are important to keep in mind. There's, of course, the widely held expectation that Basel III endgame capital requirements will be eliminated or significantly revised, but otherwise the kind of regulatory relief that banks should expect will be a broadly accommodative tenor rather than any big changes in particular. The Fed will announce its next policy decision on Wednesday, along with a new summary of economic projections. Fed funds futures are fully pricing in a 25 basis point cut, with an average estimate of the Fed funds rate ending 2025 around 3.75%. The focus for next week's dot plot will be on whether recent economic data and post-election expectations drive a shift in FOMC estimates for end 2025 policies and the longer-run neutral rate. We expect the press conference to emphasize the Fed's data dependence rather than give strong guidance on policy for the next few meetings. Also next week, November retail sales will give another important input to Q4 consumer spending estimates. Auto sales surprised to the upside last month, but the month of December will be what's most important for the quarter, considering the elevated level of holiday-fueled consumption. The November PCE data will be released next Friday, giving a more comprehensive look at consumer spending last month and the latest update to the Fed's preferred inflation metric. With the CPI and PPI data already released, the consensus estimate is for a 0.2% increase in the core PCE deflator, which would bring the year-on-year increase to 2.9%. That's all for today's episode. Thanks again for listening. I'm Will Comperl, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.